Hey, welcome back to Finty, your daily dose of world financial news. Markets, jobs, war, oil. This week had it all, and almost none of it was good news. Let's break it down. It started last weekend. The United States and Israel launched joint military operations targeting Iranian leadership and key infrastructure. Iran hit back, and hit hard, using cheap drones to effectively shut down commercial shipping through the Strait of Hormuz. Here's why that matters financially. The Strait of Hormuz is the single most important choke point for global energy. About 1/5 of the world's oil and liquefied natural gas passes through it every single day. With tanker traffic at a near standstill, oil markets went into a frenzy. Brent crude, the international benchmark, surged over 22% in just 1 week, breaching $92 a barrel. U.S. crude, West Texas Intermediate, posted its biggest weekly gain since oil futures trading began back in 1983, jumping over 35% to top $90 a barrel. Some analysts are now warning of a spike to 100 or even 150 if the disruption lasts. And then Friday came. The U.S. Labor Department dropped the February jobs report, and it was a stunner. The economy shed 92,000 jobs last month. Economists had expected a gain of around 55,000. The miss? Nearly 150,000 jobs. The unemployment rate ticked up to 4.4%, its highest since 2021. Now, to be fair, a nurses' strike at Kaiser Permanente knocked out about 30,000 healthcare jobs on its own, and winter storms hit construction hard. Some economists called it a perfect storm of temporary drags. But even stripping those out, the underlying number was still ugly. The hard truth? The U.S. economy has now lost jobs on net since April of last year. Wall Street did not take any of this well. The Dow Jones dropped 453 points on Friday, closing at 47,501. The S&P 500 fell 1.3% to 6,740. The Nasdaq slid 1.6% to 22,387. All three major indexes are now negative for the year. The Russell 2000 small-cap stocks got hit the hardest, down 2.3%. Airlines, cruise lines, freight companies, all tanking on sky-high fuel costs. The one sector celebrating? Energy. Energy stocks are up over 25% in 2026, more than double the next best sector. Oh, and Bitcoin dropped back below 68,000 after briefly hitting 73,000 earlier in the week. Risk off all around. Here's the real headache, and it's one for the Federal Reserve. Normally, when jobs disappear and the economy slows, the Fed cuts interest rates to juice growth. Lower rates, more borrowing, more spending, economy picks back up. Simple. But here's the problem. Lower rates also fan inflation. And with oil above $90 a barrel, inflation is already rearing its head again. Gas prices jumped 34 cents a gallon in just 1 week, hitting $3.32 nationally. Morgan Stanley's Ellen Zentner put it perfectly. The Fed is now between a rock and a hard place. San Francisco Fed President Mary Daly said it plainly on Friday. Both of our goals are at risk now. Markets currently expect the Fed to hold at its March meeting, with the first cut pushed out to July, and only if the Middle East situation doesn't get worse. Quickly around the world, China's government announced nearly $116 billion in new financing tools to boost domestic investment, and is allowing local governments to issue a record 4.4 trillion yuan in special bonds. Beijing is doubling down on stimulus as trade headwinds mount. In Japan, the Bank of Japan is watching the Middle East war closely, warning it could impact energy prices and financial markets. The yen weakened to around 157.6 against the dollar. And in the UK, the Office for Budget Responsibility warned that the Middle East conflict could have, quote, very significant impacts on the British economy. So here's where we land heading into this week. Oil above 90, jobs shrinking, markets down, the Fed stuck, and a war in the Middle East with no clear end date. The word everyone on Wall Street is whispering: stagflation. Low growth, high inflation. It's the nightmare combo, and right now, it's not just a risk, it's showing up in the data. Stay sharp, stay diversified, and stay tuned. I'm Finty. See you next time.